Okay, so we've gone through some of the framework to see what we're looking at in the market with regards to um, volume and volatility in certain aspects. Then we've looked at some auction market theory. We've looked at some volume profile, and we've given a little bit of analogy there. But in this part, we're going to actually try and look into how to fade. And we're looking specifically at contrarian style. So fading is when you go against um, what you're seeing on the ladder, at least at that point in time, when the market's, let's say, coming lower and you want to buy it, or the market's going up and you want to sell it. So you're not going with the momentum, you're not going with the market move, you're trying to go against it. So what are we looking for to fade and get in at certain areas? So how to fade, and obviously, like we said, this is contrarian. So looking at it more contrarian style. So before we go through how to fade, we need to know how to identify what a good level is. So how do we identify a good level? When I say level, I mean an area um, where the market's likely to bounce off of or sell off from, an area where we've seen support resistance before. That's the most important thing. In the past, have we seen support and resistance there before? If if you can identify areas where there has been selling and buying before, then there's better chance that you'll pick up on it on the ladder. Now, it doesn't go to say that you can't trade without, or you can't trade without charts. You can trade without charts. You can trade without charts, and you can trade very well without charts. You can just memorize the levels, but it does help to look at them because you can actually stay a little bit more vigilant and ready when it gets to those areas. So usually, the way I do it, and I think a lot of the traders look at things, we have a top-down approach. So we look first at the monthly. Oop, that shouldn't be there. So we look at the monthly charts. Then we look at the weeklies. Then we look at the daily, and then 60-minute, and then you move lower and lower. But overall, you're trying to pick a top-down approach. You're getting information from the larger time frame and then building your analysis to make a trade on the shorter time frame. And that's generally how we'll work things. Obviously, like I've said before, the scope of this course is not to actually show you how to, you know, work a chart or what have you. The whole point is to actually understand the framework first and then look at the ladder and understand what is happening on the ladder. The most important thing and what we're trying to figure out here is where are the institutions? Where are the institutions? Where is what we call, and we call this paper. Where's the paper? Where's the institutional flow? Where are the big boys going to be interacting? If we can understand where the big boys are going to come in, the institutional flow, the mutual funds, the hedge funds, the guys that have to move a lot of paper around, we can stay vigilant on the ladder and understand where they're going to come in and actually interact with the market. If we can understand that, that's going to give us a huge edge and a huge understanding of where to, put our trade location, where to be very, very focused on what's going on the ladder. Now, another thing that I do personally, and I think it really does help in your trading, is keep a diary of price action in certain zones. So keep a diary of levels and price action in those zones. Now, why would I do that? I've got a chart. Why would I keep a diary of the levels? This is really important. If you want to understand how to trade price action and trade off the price ladder, you have to understand that there's certain areas that have reacted differently. So we've gone through absorption. We've gone through big buyers and big sellers coming in on the order book. We've gone through algorithmic trading. So if we understand that, for example, we had a very significant level around this area in here. So let's just try and just bear with me for a second. I've got just open up my magic little pen. So if, for example, we knew that we had a very, very important level in here at 157.87 in the past, what was the price action like when we bounced off that level? Last time we came down to this level and we bounced off, did we come down to this level? So did we come down to the level at 87s, range for a bit, then false break, then come back inside and then rotate higher? Is that how the structure of the market was? Or was it more a case where we came down to these 87s, and as soon as we touched 87s, we reversed very, very quickly? Was it a case where we came down to these 87s, we came down to the, let's say, the 91s or 90s, came down, let's just try and draw this a little bit better, came down to 90s, let's say, for example, bounced a little bit, then we had a false break down to 87s, and then we had a complete reversal. Did we see absorption? Was there a large absorption buyer? Do we know that there's a very large absorption buyer in that place? Was there a lot of volume done in that area? If so, then potentially below these 87s, this whole area below these 87s, we might have a lot of stops. If there's a lot of absorption, and was it a really big area for buyers? Did it seem really important for them to buy around that area? So we have to start understanding the structure and understanding where and how the market trades off these levels. And specifically, what was the price action like? Did we come up to a very, very important level in, let's say, a yield level in the Bund, and then completely, reverse the whole day and then some? Lower day here, previous low of day, high of day, and then we just completely reversed the whole day in here on very high volume. If I saw very high volume, I know there's a huge seller here. It's on the price data that's going to give you the clue. The levels that you see, if I just showed you any chart, and you saw a lot of this, you saw a lot of this, and I could tell you right now that there's a level here and a level here. But if I told you at this level, we saw, heavy selling, finally there was heavy selling there, you'd be a lot more inclined to sell this level than to sell, for example, one of these levels in here, or any other level on a chart. Let's say we broke out here and there was another level over here. Not much selling, low volume, kind of just trickle down. All right, wasn't a lot of interest in that level. However, this level, for some reason, had a lot of selling. It's very hypothetical now. You don't normally get, a level below another level that sells off better. But just telling you hypothetically, if you understood that there was a very big seller there on the price ladder, you could see him physically coming to market and trading lots of size. That is going to make you very wary next time it comes to that area. If you've got the diary and you understand and you jotted down those levels, you're going to be a lot more vigilant when it gets to them. And I'm telling you right now, it adds a tremendous amount of understanding of where the market could potentially go. If you've seen enormous absorption at a certain level and the market's now moving up off of it, are we about to develop a very strong trend? Did someone really have to buy a lot and now has to come to market? So understanding these levels is the key behind them potentially working in the future. Did I see buying? Did I see selling? It's as simple as that sometimes. Where were the institutions taking place or trading heavily? So that's basically how we're going to try and sum up what these key levels are. In the next video, we're going to actually look at when a market got to a very specific area and how it auctioned off of it. We'll take a look at that in a second.